Hello and welcome to Shrouded Securities. I'm your host, Spooky, and today we'll be discussing the Vanguard Growth ETF, known by its ticker symbol, VUG. Launched in 2004, VUG is an exchange-traded fund that seeks to track the performance of the CRSP U.S. Large Cap Growth Index, an unmanaged benchmark representing large U.S. growth companies. As of March 31, 2024, the fund had over $226 billion in assets under management, making it one of the largest ETFs in its category. This fund is quintessentially Vanguard, an ETF tracking a public index of large cap stocks delivered to investors at rock bottom, nearly imperceptible fees. As one of the top 10 largest ETFs by AUM, VUG is a staple of retirement accounts across the United States. VUG is managed by Vanguard's Equity Index Group. The team uses indexing strategies to closely replicate the holdings and performance of the benchmark index while minimizing tracking error and keeping costs low. As of March 31, 2024, VUG held 199 stocks. The fund is heavily concentrated in the technology sector at 56% of assets, followed by consumer discretionary at 19% and healthcare at 7%. The top 10 holdings, which include giants like Microsoft, Apple, Nvidia, Amazon, and Facebook, comprise about 56% of the fund's total assets. Over the past few years, large-cap growth stocks have outperformed the broader market, driven by factors such as low interest rates, strong earnings growth, and investor enthusiasm for disruptive technologies. However, as interest rates rise and valuations become stretched, some investors are growing cautious about the future performance of growth stocks. One of VUG's primary advantages is its low expense ratio of 0.04%, which is 92% lower than the category average. This cost efficiency allows more of the fund's returns to accrue to investors. The fund has also been tax efficient, with annual turnover of around 5%. Investors may consider VUG if they seek broad exposure to large-cap U.S. growth stocks and believe in their long-term potential. The fund offers a diversified way to gain exposure to some of America's most innovative and dynamic companies. However, investors should be aware of the risks associated with VUG. As a growth-oriented fund, it may experience higher volatility and larger drawdowns during market downturns compared to broader market ETFs. The fund's heavy concentration in the technology sector and its relatively narrow portfolio of 199 holdings may also lead to underperformance during periods when value stocks or other sectors are in favor. As with any investment, it's essential to consider your risk tolerance, financial goals, and time horizon before investing in VUG. While the fund can play a role in a well-diversified portfolio, it should not be the sole component of an investment strategy. In conclusion, the Vanguard Growth ETF offers investors a low-cost, tax-efficient way to gain exposure to large-cap U.S. growth stocks. While the fund has performed well in recent years, investors should remain aware of the potential risks and consider their individual circumstances before making investment decisions. As always, Shrouded Securities aims to provide informative content, but we are not investment advisors, and we don't endorse any fund. Please consult with a financial professional before making any investment decisions. Until next time, I'm Spooky, wishing you success in your investing endeavors.